Most people believe bonds are the safest investment in finance. That belief has existed for decades. Retirement advisors repeat it, financial planners recommend it, and millions of people trust it without ever checking the math. But in one single year, so-called safe bonds quietly erased billions of dollars. And in some cases, they lost more money than stocks. Not a rumor, not a prediction, a documented fact. The math behind bonds tells a completely different story than the one you were taught. And by the end of this video, you will understand exactly why one of the safest assets in finance can quietly become one of the most dangerous. Here's the strange part. Even people who have never purchased a single bond in their life are still controlled by them, because the bond market quietly shapes your mortgage rate, your car loan, your retirement account, your savings account interest, your credit card interest, the job market you work in, and sometimes the entire economy itself. This is not a niche topic reserved for Wall Street professionals. This is the machinery quietly running underneath your entire financial life. Pension funds hold trillions of dollars in bonds on behalf of teachers, firefighters, and everyday retirees. Insurance companies use bonds to guarantee the payouts on your life insurance policy. Governments use the bond market to fund highways, hospitals, and schools. The global bond market is now worth more than $140 trillion. That makes it larger than the entire global stock market combined. It is one of the largest financial systems ever built. And most people have absolutely no idea how it actually works. But here is what matters more than the size of the market. There is one mathematical rule hiding underneath all of it. A rule most investors never learn until it is too late. And this one rule changes everything. Here is the rule almost nobody understands. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. Always. No exceptions. Now, that sounds harmless. But here is what financial advisors rarely explain clearly. This one rule means a so-called safe bond can lose a huge amount of value overnight. Here is why. Imagine you buy a $1,000 bond, paying 3% interest. You expect $30 every year. Everything feels safe. Then suddenly, new bonds are issued paying 6%. Why would anyone buy your bond, paying half the interest of the new one? They would not. So the price of your bond begins falling. Not because anything broke, not because a company failed, but because mathematics forced it downward. Now flip the scenario. Interest rates fall. New bonds start paying less. Suddenly, your old bond, still paying the higher rate, becomes valuable. Investors are willing to pay extra just to own it. Its price rises. Same rule, opposite direction. This is the part almost nobody tells you when they say the word bond. A bond is not one fixed thing. It is a moving price, constantly recalculating itself against every other rate available in the market. If you hold a bond until it matures, none of this matters. You get your money back, plus interest, exactly as promised. But almost nobody holds a bond fund to maturity. Most people hold bond funds that are constantly buying and selling underneath them every single day, whether the owner realizes it or not. And this is where most people make their first mistake. They see a falling bond price and assume something is broken. But often, nothing is broken at all. The bond is simply obeying a mathematical law that has existed for centuries. Almost nobody checks this before they invest. They see the word bond, and they stop thinking about risk completely. But this is not the dangerous part. It gets worse. Meet Daniel. Daniel is 48 years old. He has spent 20 years building his retirement savings, one paycheck at a time. His financial advisor gave him very standard advice. As retirement gets closer, move money out of stocks and into bonds, because bonds are safer. It is advice repeated in almost every retirement planning book ever written. So Daniel moves $300,000 into a bond fund. He signs the paperwork. He stops checking the account as often. For the first time in years, he feels calm about retirement. He believes his money is now protected. But suddenly, interest rates begin rising. Slowly at first, then faster. And Daniel notices something terrifying. His supposedly safe retirement account starts falling. $5,000 gone, then $10,000, then $20,000. And Daniel cannot understand why. After all, he was told bonds were safe. He was told this was the boring account, the safe account, the one you do not have to watch. He calls his advisor. He rereads his statements, line by line. Nothing makes sense to him. The account he moved money into specifically to stop losing sleep is the exact account now keeping him awake. Here is what financial advisors almost never explain clearly enough. There is one mathematical number buried inside every bond fund's fact sheet. Most investors never look at it. Most advisors never walk their clients through it. It is called duration. Daniel had never heard the word before in his life. And this is where things become dangerous. Every bond fund has a number attached to it. Most investors never look at it. That number is duration. Duration measures how sensitive your bond fund is to interest rate changes. Here is the simple version. A duration of 10 means if interest rates rise 1%, your bond fund loses roughly 10% of its value. A duration of 12 means the same 1% rise costs you roughly 12%. Simple math, but almost nobody calculates it before they invest. Here is why the number gets so large for some bond funds. The longer it takes a bond to repay you in full, the more future interest payments are exposed to changing rates, and the higher its duration climbs. A bond maturing in 2 years might carry a duration near 2. A bond maturing in 30 years can carry a duration well above 15. Same word, bond. Wildly different exposure. A short duration bond fund might barely notice a rate hike. A long duration bond fund can get devastated by the exact same rate hike on the exact same day from the exact same news headline. 2 investors, 2 accounts labeled safe, 2 completely different outcomes. Now return to Daniel. His $300,000 bond fund has a duration of 12. Interest rates rise by 2%. Duration 12 times a 2% rate increase equals a loss of roughly 24%. 24% of $300,000 equals $72,000. $72,000 disappears. Not because the economy collapsed, not because the company failed, not because anyone stole his money, but because of a mathematical relationship he never understood and nobody ever explained to him. And millions of investors made this exact same mistake. They trusted the label safe, instead of checking the one number that actually determines risk. One overlooked number, $72,000. That is the price of not checking. This is not a theory. This already happened. In 2022, the Federal Reserve aggressively raised interest rates to fight inflation. The Federal Reserve began that year with rates parked near zero. By the end of the year, rates had climbed above 4%, one of the fastest tightening cycles in over 40 years. And the consequences shocked millions of investors. The United States bond market suffered its worst year in modern recorded history. The Bloomberg U.S. Aggregate Bond Index, the benchmark most retirement funds are measured against, lost more than 13%. Long-term zero-coupon treasury bonds, the longest duration bonds that exist, fell nearly 40%. Read that again, nearly 40%. Assets that millions of people believed were safe collapsed harder than many stock portfolios that same year. The classic 60-40 portfolio, 60% stocks, 40% bonds, built specifically to reduce risk, posted one of its worst years on record. The bonds were supposed to be the cushion. Instead, the cushion fell right alongside the stocks it was meant to protect. For decades, investors were taught a simple story. Stocks grow wealth. Bonds protect wealth. But in 2022, the math broke that story completely. Retirees who had followed standard advice and shifted into bonds right before retirement watched years of careful saving shrink in months. Some delayed retirement entirely. Some quietly went back to work, not because they were reckless, because a number they never checked turned out to be the most important number in their entire portfolio. And the financial world learned something uncomfortable. Safe assets are only safe if you understand the mathematics behind them. And almost nobody had been taught that lesson before 2022 forced it on them. The problem becomes even worse than that, because most people believe if something is labeled low risk, it cannot cause serious damage. But low risk and low volatility are not the same thing. Risk is not a feeling. Risk is not a marketing label printed in a brochure. Risk is mathematics. And sometimes, slow-moving mathematical systems quietly cause the biggest damage of all. This is exactly why millions of retirement accounts lost money in 2022. Not because people made reckless decisions, not because they gambled on speculative assets, but because they trusted a label without ever checking the number underneath it. Think about it this way. A stock can swing wildly in a single day and still recover by Friday. That is volatility. A long-duration bond fund can decline slowly, quietly, month after month, with no dramatic headline attached to it at all. That is risk wearing a disguise. The stock felt scarier. The bond fund was, in that specific year, more damaging. So here's a fair question. If the danger was always sitting right there in the numbers, why did almost nobody see it coming? Because almost nobody checks it. The duration number is printed on nearly every bond fund fact sheet. It takes 10 seconds to find, and it could have warned Daniel and millions of investors like him months before the losses began. But here is what makes this pattern so easy to repeat. The warning sign does not look dramatic. It is not a red flashing alert. It is a small number sitting quietly in a fact sheet, waiting for someone to actually look. And almost nobody does. Even if you never buy a single bond in your life, this still affects you. Because bond yields determine borrowing costs across the entire economy. As bond yields rise, mortgage rates rise, car loan rates rise, corporate borrowing costs rise. When it costs companies more to borrow, they hire less. Some freeze hiring entirely. Some begin layoffs. Economic growth slows. Stock prices across the entire market often move in response to these same bond yields, because investors are constantly comparing stock returns against what a safe bond now pays. Even government spending is shaped by this number, because governments themselves borrow by issuing bonds. When bond yields rise, it costs governments more to fund roads, hospitals, and schools. One single number, the interest rate on government debt, quietly ripples through your mortgage, your employer's hiring plans, and your country's budget all at once. The bond market quietly controls far more of your financial life than most people ever realize. Every major financial institution watches these numbers every single day. Central banks watch them. Hedge funds watch them. Pension funds watch them. The average person never does. They check the price of milk. They check gas prices at the pump. They almost never check the number quietly setting the price of nearly everything else in their financial life. And that knowledge gap costs ordinary people enormous amounts of money year after year without them ever realizing why. So what do smart investors do differently? First, stop thinking the word bond automatically means safety. Safety is not a category of asset. Safety is a mathematical outcome that depends on the numbers you are willing to check. Second, learn the duration number before buying any bond fund. It is public. It is printed. It takes seconds to check. Third, understand that interest rate environments change everything about how a bond behaves. The same fund that felt calm for 10 years can behave completely differently in year 11. Fourth, match your bond duration to your own time horizon, instead of copying advice built for someone else's situation. What protected your parents in a falling rate decade is not automatically the right fit for a rising rate one. Fifth, never trust any financial product until you understand the mathematics underneath it. Because money does not disappear randomly. There is always an equation behind the loss. And the people who understand those equations see financial danger before everyone else does. They are not smarter than Daniel. They simply checked one number he never knew existed. That is not luck. That is arithmetic. Most people never lose money because they made reckless decisions. They lose money because they trusted systems they never fully understood. The truth is simple. Finance is mathematics. And every financial product has hidden equations, quietly determining what happens to your money. Bonds, mortgages, retirement accounts, all of it runs on numbers most people never learn to read. If you want to understand the math behind wealth before it costs you, subscribe to the Real Wealth Math. The math does not lie, but the banks might. I will see you in the next one.